Here, the trading algorithms obtained directly from the base indicator are described. The trading algorithms derived directly from the base indicator are base indicator greater than threshold, base indicator positive, base indicator less than threshold, base indicator negative, base indicator between thresholds. The algorithm base indicator greater than threshold checks whether the base indicator is greater than the threshold, that is a particular value input by the user. So the algorithm is true if and only if the base indicator is strictly greater than the threshold. The algorithm base indicator positive checks whether the base indicator is positive, so the algorithm is true if and only if the base indicator is strictly greater than 0. The algorithm base indicator less than threshold checks whether the base indicator is less than a threshold, that is a particular value input by the user. So the algorithm is true if and only if the base indicator is strictly less than the threshold. The algorithm base indicator negative checks whether the base indicator is negative, so the algorithm is true if and only if the base indicator is strictly less than 0. The algorithm base indicator between thresholds checks whether the base indicator is between two thresholds, that is two particular values input by the user. So the algorithm is true if and only if the base indicator is strictly greater than the lower threshold and strictly less than the upper threshold. In general, the threshold can take on any value between negative infinite and positive infinite, but for each algorithm can have its own bounds detailed in the parameters paragraph in the description pane. The greater than algorithms are particularly useful for bounded indicators like the RSI. According to the literature, for instance, if the RSI is greater than 70, there's a strong uptrend or an overbought market. So select the algorithm RSI greater than threshold and input a threshold of 70. As you can see, a lot of information is reported in the description pane. The literature signals assume you're checking for a high threshold, not a low one. This is exactly what we're doing here, but you can input any threshold, just ponder carefully its meaning in terms of signals. The parameters section reminds you the range of the threshold, which corresponds to the range of the RSI. If you run it, you can see the algorithm is true, equal to 1 in charts, whenever the RSI is greater than 70. Otherwise it is false, 0 in charts. Where the algorithm is true, the market is classically considered in strong uptrend or overbought. If you favor the strong uptrend, you should use this algorithm in the long tab to enter a long position. If you favor the overbought, you might consider using this algorithm in the Liquidate long tab to liquidate long positions. Analogously to the previous example, according to literature, if the RSI is less than 30, there is a strong downtrend or an oversold market. By selecting the RSI less than threshold algorithm and inputting a threshold of 30, you can see when this happens. When the algorithm is true, the market is classically considered in strong downtrend or oversold. If you favor the strong downtrend, you should use this algorithm in the short tab to enter a short position. If you favor the oversold, you might consider using this algorithm in the Liquidate short tab to liquidate short positions. According to literature, if the RSI is around 50, there is a congestion. By selecting the RSI between thresholds algorithm and inputting, for instance, lower threshold 45, upper threshold 55. You can see when this happens. Where the algorithm is true, the market is classically considered in congestion. Conventional trend-following algorithms assume a trending market. A typical example is to enter a long position when the close price goes above the moving average of the price. However, in a congestion phase, you might want to apply the opposite of the trend-following algorithm, that is to enter a long position when the close price goes below the moving average of the price. You can do that by ending the two algorithms together in the Long tab. Usually, you should not trade trend-following algorithms during a congestion phase of the market. As seen in the previous example, you can check whether the RSI is within a range of values, but if you select the Not checkbox of the algorithm, the logic is inverted, and hence we can check whether the RSI is outside the range. If we do that, with the same thresholds as in the previous example, we obtain the inverted figure. Now we are checking when the market is not in a congestion phase. You can end this algorithm with a trend-following algorithm to make sure you apply the trend-following technique only out of congestion. Through the greater than threshold algorithms, you can spot periods of high volatility in the market. Just pick up a volatility indicator and check when its value is higher than a threshold. For instance, the standard deviation is one of the most used. In order to make it more consistent throughout price ranges, we can use its percentage version. When the algorithm is true, volatility is high. If you want to liquidate your positions when volatility is high, put this indicator in the Liquidate tabs. Maybe in the only one present when not distinguishing between long and short. If you want to spot where volatility is low, check when a volatility indicator is less than a threshold. As in the previous example, we can take the standard deviation in its percentage version. When the indicator standard deviation percentage less than threshold is true, volatility is low. If you want to enter a long position only when volatility is low, end this algorithm with another algorithm saying when to go long in the Long tab. Examples of application for algorithms indicating an uptrend when positive are checking whether the market is trending. An indicator like the momentum is classically considered to indicate an uptrend when positive. So select this algorithm for the momentum. Where the algorithm is true, the market is uptrending. You can use this algorithm in the Long tab to enter a long position. Similarly to the previous example, you can use algorithms indicating a downtrend when negative to highlight downtrending market. For instance, select the momentum negative algorithm. Where the algorithm is true, the market is downtrending. You can use this algorithm in the Short tab to enter a short position. The Bollinger Band is thought to forecast an imminent strong trend when its width squeezes. If you want to adopt this strategy, you want to detect when the squeeze is over. For this, the idea is to exploit the step checkbox of algorithms, where the transitions from false to true is detected. If you select the Bollinger Band with percentage greater than threshold, you check where the width has a high value. If you select its step checkbox, you detect where the width passes from small to big, that is when the squeeze finishes. According to the literature, this is the time when a strong trend begins. So this is the algorithm without a step. It checks where the width is large. This is the algorithm with the step. It checks where the width passes from narrow to large. If you end this algorithm with a trend-following one, you get a high probability to run the trend. One of such a trend-following algorithm classically is the breakout of the band, so you can pick up the high greater than MA of Bollinger Band upper line, maybe with different input parameters.